Welcome to the Deep Dive, where we cut through the corporate noise to bring you the clearest insights from the latest earnings calls. Today, we're taking a deep dive into Netflix's Q2 2025 earnings interview. Our mission is really to pull out the most important nuggets of knowledge and insight.
Yeah, give you that shortcut to being truly well-informed about, well, the entertainment giant.
Exactly.
We're going to try and unravel their financial performance, decode what management's thinking strategically, and explore what it all means for the competitive landscape in entertainment and maybe even beyond.
Okay, let's unpack this call then and see what truly stood out. So to kick things off, let's start with the headline numbers. What's the snapshot? What does Netflix's Q2 2025 performance and their updated full-year outlook tell us?
Well, the big news, I think, is a pretty significant bump in their full-year revenue guidance, now projected to be between, let's see, $44.8 billion and $45.2 billion. So that's about a $1 billion increase at the midpoint from the previous forecast. And interestingly, it's a tighter range, too, which, usually signals increased confidence for management.
Right. $1 billion higher, more confident. That's a strong revision.
Right.
How much of that is like genuine business momentum versus just, say, favorable currency shifts? We've seen that before.
Yeah, that's a crucial question, always. And while, look, a good chunk of that revenue lift is because the dollar's been weaker, favorable foreign exchange, management was really explicit. They emphasized that the underlying business strength is also a significant contributor here. They saw, quote, healthy member growth, which actually kind of surprisingly accelerated towards the end of Q2, beat their own expectations.
Oh, interesting.
Yeah. And this growth plus, a strong content slate they're pointing to, they expect that to continue right into the second half of the year.
So if revenues are up and it's partly real business strength, is that flowing down? Is it hitting their profit margins?
Absolutely. That's the other key part. Operating expenses remained essentially flat in their forecast.
Okay.
So this means those higher expected revenues are largely translating straight into higher profit margins. Their updated full-year reported operating margin target is now up a full point, went from 29% to 30%.
Wow, a full percentage point.
Yeah. And if you strip out the currency effects, the FX neutral margin, that's up 50 basis points, which really, it underscores that positive impact from stronger membership growth and their advertising business kicking in.
Okay, so with that strong initial outlook, let's dive deeper. Let's get into the, pivotal financials, the strategic shifts, the management insights that really shaped this call.
Right.
First off, about that 30% full-year operating margin guidance, it sounds impressive. But is there maybe more to the story, especially since Q2 and Q3 forecasts are actually even higher than that?
There is, yeah. You picked up on a good point. Management clarified that the 30% full-year guidance, even though you see strong individual quarters like the forecasted 31.5% for Q3, it's primarily a timing issue.
A timing issue. What does that mean exactly? Like how they manage their content spend? Because that's obviously massive for them.
Exactly. It means they manage the business to full-year margins. So content expenses are actually set to ramp up pretty significantly in Q3 and Q4.
Oh, okay.
This is driven by, many of their biggest new and returning titles, plus the live event stuff launching in the back half of the year. And historically, Q4 also just tends to have a heavier film slate for them.
Right.
They'll also boost marketing spend to support all this new content, and they're going to keep, aggressively building out their ad sales infrastructure. But the key takeaway, they stressed, is that even with this ramp up, they still expect operating margins to be up year over year in every single quarter, including Q4.
So it's controlled spending, basically.
Yeah. Controlled spend for maximum impact seems to be the idea.
Okay, speaking of advertising, the ad sales business, you mentioned it, reportedly on track to roughly double its revenue this year. What's driving that momentum? What's got advertisers suddenly so excited about Netflix?
Well, first, their U.S. upfront negotiations, where advertisers commit spend way in advance, those are largely complete now. And they said they generally met or even slightly exceeded their targets there.
Good sign.
Yeah. And what's attracting advertisers, it's a few things. Netflix is growing scale, obviously. They're highly attentive and engaged audience. They really push this point, saying it's a cut above many peers. Then there's the recent rollout of their own ad tech stack, which is a big deal. And of course, that impressive content slate, which now crucially includes a growing number of live events. That's new bait.
Okay, tell us more about this new ad tech stack. What is it? What's the immediate impact and maybe the longer term potential?
Right. So this is their proprietary in-house Netflix ad suite. They rolled it out across all their ad markets globally, and they said it was very smooth. Performance metrics look good. Early results are in line with what they expected.
Okay.
The immediate benefit is just making it way easier for advertisers to buy ads on Netflix, particularly through increased programmatic buying, the automated data-driven stuff.
Right. Efficiency.
Exactly. Long term, this tech stack basically improves their speed, how fast they can roll out new features, things like better targeting, better measurement of ad effectiveness using third-party data. They're also set to introduce interactivity in the second half of the year.
Interactivity, like clickable ads?
Something like that, yeah, and improving ad personalization for members too. So this is a really significant milestone for them. It shifts them into like a steady release cycle for new ad features, and that's absolutely critical if you want to scale an ad business this big.
Let's shift gears a bit.
Yeah.
Content and engagement.
Yeah.
How is Netflix measuring up there, especially, with all the competition heating up?
Yeah, good question. Total viewing hours, they said, did grow slightly in the first half of 2025, which is interesting because their content slate is actually heavily weighted towards the back half of the year.
Right.
For engagement, they've been focusing on this metric they call an owner household basis, which basically tries to account for the impact of paid sharing, cracking down on passwords. And the good news for them is that this metric, this owner household engagement, has remained relatively steady over the past, say, 2.5 years, even with all that intensifying competition.
That's interesting. So steady engagement, how does that translate into their content strategy? And what does it mean for viewership going forward? Or are they just trying to hold the line?
Well, the core insight they shared here is that while a single title, even like a massive global hit, typically only drives about 1% of total viewing.
Only 1%. Wow.
Yeah. So Netflix isn't really chasing just single blockbusters. They're focused more on what they called a steady drumbeat of quality content across shows, films, games, just constantly adding value. They highlighted 44 individual Emmy nominations this year as sort of concrete evidence of what they call quality at scale.
Right. Consistent value, not just peaks.
Exactly.
And when we look at that content pipeline,
yeah.
Okay, here's where it gets truly fascinating, I think. What does their upcoming slate actually look like?
Oh, yeah, indeed. The second half of 2025 is just absolutely stacked. Major returns. You've got Squid Game 3 coming back.
Already. Season 3.
Season 3, yeah. Already the third most popular non-English series ever for them. Plus Wednesday, Stranger Things. The big guns are back. They also teased what they called, and this is quite a claim, a potentially most anticipated slate of new movies ever, starting with Happy Gilmore 2.
No way. Really?
Yep. A new Knives Out film, new films from top directors like Noah Baumbach, Catherine Bigelow. It's serious firepower.
And it doesn't just stop in 2025, right? They're already talking further out.
Exactly. 2026 looks incredibly strong, too. Films like The Rip from Ben Affleck and Matt Damon, Apex with Shirley Starr, Enola Holmes 3 with Bobby Brown. Remember, Enola Holmes 2 was their biggest movie in 2023. Plus, Greta Gerwig's Narnia. I mean,
wow.
Returning series include Bridgerton, One Piece, Avatar, The Last Airbender, Beef. They also highlighted big international hits returning, like Lupin from France, Berlin from Spain, Colombia's 100 Years of Solitude, plus brand new shows like Man on Fire, The Burrows from the Duffer Brothers, unscripted stuff like the Star Search reboot.
Okay, it's a lot. An aggressive, diversified play.
Absolutely, trying to dominate every entertainment niche, basically.
But with such an immense amount of content, how are they addressing those concerns about domestic viewing share stagnation? The Nielsen Gauge data seems to suggest things have flattened out a bit in the U.S.
Yeah, that's a fair challenge, and they did address it. While that Nielsen data does indicate some stagnation, Netflix's line is that their long-term goal remains continuous growth in share. They emphasize, look, we've maintained share even with more streaming competition than ever, and the impact of rolling out paid sharing. Their strategy, they say, is simply to continuously improve the service.
No. Just more content.
Well, partly, yeah. A key metric they pointed to is content amortization, basically how they expense the cost of their shows over time. That number has grown over 50% since 2020.
50% increase in content cost recognition.
Yeah. And their argument is that this sustained increased spending has historically led to more engagement, more revenue, more profit, driving what they call that positive flywheel of growth. Just keep adding value globally.
Speaking of global, they recently announced this new partnership with TF1 in France.
Yeah.
What's the core thinking there? Is it just about adding more content or something deeper?
Well, at its core, the TF1 partnership is about beefing up their entertainment lineup in France. They're seeing strong demand from members there for more variety, more breadth, and particularly highly relevant local content, French content for French viewers.
Right.
This deal is just an accelerated way to satisfy that specific need. It also signals, I think, a willingness to partner strategically to fill those local content gaps faster than they could maybe build it themselves.
And why TF1? Why now?
Good question. They said they've invested in the underlying capabilities like live ads and the new user interface we'll talk about, which makes these kinds of deals more viable now. They chose TF1 specifically because, well, they have an existing strong relationship. France is obviously a big, important territory. TF1 is a leading local programmer there. And they said both companies are highly aligned on, mutual value creation and figuring out how to scale local content effectively. It sounds like a strategic beachhead for maybe deeper local integration down the line.
Moving from partnerships to their own stuff, Netflix's approach to live events, it seems quite specific, not just broadcasting anything. What's the strategy?
Yeah, it's definitely focused. Their live strategy remains tightly centered on what they call ownable big breakthrough events, things audiences genuinely love and that make economic sense for Netflix.
Ownable, meaning exclusive.
Pretty much, yeah. Things people associate with Netflix. And while live events are still, a relatively small part of their overall content spend and viewing hours, they really emphasize the outsized positive impacts. Things like driving conversation, helping acquire new members, retaining existing ones. It's about oventizing their platform, making it a destination.
Okay, can you give us a quick rundown of what's actually in their current live portfolio?
Sure. Right now, they're highlighting the Canelo-Crawford fight coming up in September, the SAG Awards, their weekly WWE matches, which is a big commitment, and the NFL Christmas Day doubleheader, Dallas versus Washington and Detroit versus Minnesota.
Big games.
Huge games. And while it's primarily U.S.-based for now, they explicitly stated plans to invest and grow live capabilities for events around the world in the years ahead. So expect more international live stuff.
And how are they actually doing this, building the capability to produce these massive live events? Are they relying on partners like for the NFL or bringing it in-house?
It's a mix. They drew an interesting analogy, actually, to their early days and original scripted shows.
Oh, yeah.
Remember, they initially relied heavily on external studios, right? But then they developed in-house muscles for shows like Stranger Things. For live events, they see this mix of partnerships and self-producing as a scaling tool. So yeah, they partner with CBS for the NFL games, for example, but they are also actively building their own capabilities. They pointed to a recent success where they handled concurrent live events, the Taylor versus Serrano fight and WWE SmackDown, delivered with high quality. So it's very much a learn-by-doing approach. They want to become world-class at it and quickly.
Before we transition fully to product, let's just quickly circle back to content. There was a fascinating anecdote about K-pop Demon Hunters. Yep. What were the key learnings from that film's phenomenal success?
Yeah, that was a standout, particularly because it was an original animated feature, which is historically a really tough genre to crack, especially for streamers. Netflix is seeing real hits there now.
Right.
The key takeaways they mentioned: the right mix of music and pop culture, obviously strong storytelling, and real animation innovation. Critically, the music from the film, specifically songs Golden and Soda Pop, became enormous hits on their own. Yeah, driving fandom, really piercing the culture, as they put it, all through a film that's only available on Netflix. It's a perfect example for them of that quality at scale content strategy really paying off and creating its own ecosystem.
Okay, let's transition now to their product strategy, specifically thinking about service tiers. Will Netflix always offer all content at both ad-free and ad-supported price points? It feels like a core principle now, but things change.
Yeah, that's a good question. Management basically stated they've learned to never say never about evolving their consumer-facing model. Things can always change.
Fair enough.
However, they are currently guided by some core principles. Number 1, providing members choice, different price points, different features. 2, ensuring accessibility for new members globally, keeping entry points open. 3, achieving reasonable returns on the entertainment value they provide so they can reinvest. And they also consider just the complexity of their offering. Don't want to confuse people. So for now, they believe the bundle, having everything available, remains a great value. And they expect it to be an important feature for the foreseeable future, offering that huge range of entertainment easily and affordably.
The new UI UX, the user interface and user experience, that seems to be a really big deal for them right now. Why is it so important? especially now with live content in the mix.
Oh, it's absolutely crucial. They basically said the previous UI was designed for the Netflix of like a decade ago, mostly on-demand scripted stuff.
Right, binge-watching central.
Exactly. The business has evolved so much since then. Much wider breadth of entertainment games, live events. The new UI is vital because discovering these new types of content is inherently different. For example, guiding members to tune in for a live event at a specific time. That's a totally different job for the interface than just recommending the next episode of a series.
Makes sense.
And this new UI, it also leverages newer tech, things like real-time recommendations. It allows Netflix to dynamically respond to what you might need right now. So the Netflix you see on a Tuesday night could look and feel totally different from the one you see on a Sunday afternoon.
Personalized in real time.
Yeah. And they're already seeing performance improvements even beyond what they saw in pre-launch testing. They see this new UI as a massive force multiplier for that huge content investment we talked about, connecting members with titles they'll love faster, easier, and also improving the ad experience significantly.
Okay, another hot topic was competition, particularly YouTube, which interestingly actually exceeds Netflix in US TV timeshare, according to Nielsen. How are they thinking about working with YouTube creators, or even creators from TikTok, other platforms?
Yeah, they address this directly. They basically expressed a desire to work with the best creatives on the planet, period, regardless of where they come from, Hollywood, Korea, India, or social media platforms like YouTube or TikTok. Netflix offers them, phenomenal global distribution, desirable ways to monetize, brilliant discovery tools within the platform, and just a huge hungry audience. Now, obviously, not everything from YouTube is going to fit Netflix.
Right.
But they have seen successes already. They highlighted Miss Rachel, who apparently garnered 53 million views in the first half of 2025 just on Netflix. And they're excited about other creators, too, like the Sidemen. So they're definitely open to it.
That's a fascinating approach, being platform agnostic about talent.
Yeah.
So how does Netflix really see itself competing in this vast dynamic entertainment market? It's not just other streamers anymore, right? It's social media, gaming, free services.
Absolutely. They fully acknowledge the massive competition. Linear TV, other streamers, video games, social media. They also specifically called out free services as powerful competition. You can't ignore free.
True.
However, they emphasize this point. Not all hours are created equal. Netflix has a strong profit model, right? So they're focusing on winning the most profitable moments of consumer attention.
Okay. Quality over just quantity of hours.
Kind of, yeah. And crucially, they threw out the stat. Roughly 80%, 80% of total TV viewing share is not currently won by either Netflix or YouTube.
80% is still up for grabs.
That's their view. A massive open opportunity that they're aggressively competing for. That's the battlefield.
Let's discuss a pervasive buzzword, generative AI. Where does Netflix see its biggest impact on their business? Is it just cost cutting?
No, interestingly, they framed it differently. They believe AI is an incredible opportunity to help creators make films and series better, not just cheaper. The emphasis was on enabling creativity through AI-powered tools.
Okay.
Well, they're already seeing benefits in production. Things like pre-visualization, shot planning, visual effects, making advanced effects like, say, de-aging much more accessible, even beyond huge blockbuster budgets.
Right.
They shared this really fascinating anecdote about their production, Elton Tonada. AI-powered VFX enabled a whole building collapse sequence to be completed 10 times faster, and at a cost that would have been totally unfeasible with traditional methods. And apparently, that was the very first Gen AI final footage ever used in a Netflix original.
Wow, 10 times faster. So AI isn't just back-end stuff. It's actually impacting the creative process directly.
Yeah.
Any broader implications they mentioned?
Absolutely. Beyond content creation itself, they see tons of opportunity in the member experience. I mean, they've been doing personalization for 2 decades, right? But new generative techniques can make it even better.
How so?
They're actually piloting a conversational experience within the UI, allowing you to use natural language search. Like, you could literally just ask, find me a film from the 80s, a dark psychological thriller.
Oh, like talking to Netflix.
Kind of, yeah. And again, they see that as another force multiplier for their content investment, helping you find exactly what you want instantly. And in advertising, too, Gen AI can significantly lower the barrier for brands to create cool, integrated spots within Netflix titles, making those compelling integrations much more scalable.
Okay, lots of potential there. Finally, let's touch on gaming. Still seems pretty early days, but what about near-term monetization opportunities? Are they going to start charging for games soon?
They view gaming monetization pretty much like how they viewed other new content categories early on. The idea is deliver more value that drives increased user acquisition, better retention, and ultimately a higher willingness to pay for the overall Netflix service.
So it adds value to the bundle for now.
Exactly. They have seen positive effects, they said, albeit small so far, from members who actively play games. They plan to ramp up their investment here. It's still tiny compared to their overall content spend, but they stress they remain disciplined. They've seen good progress with both licensed games like the Grand Theft Auto titles they had.
Right, that was big.
And also their own self-developed titles like Squid Game Unleashed. So they're open to evolving the monetization model down the line, maybe standalone game subscriptions or in-game purchases, but they openly admit they need much more scale first, given the, as they put it, very, very large total addressable market for gaming. Long game there.
Okay, one last strategic question then. M&A, mergers and acquisitions. Netflix has a healthy balance sheet. We're seeing consolidation happening in global media. What's their view on maybe buying successful IP or studio assets or making a big splash?
Yeah, they tackled that. Netflix agrees. Consolidation in legacy media, yeah, that's likely going to continue. But they don't actually believe it materially changes their competitive landscape all that much. They've historically been, in their words, builders rather than buyers, and they still see significant runway for organic growth without needing to change that playbook.
So no big shopping spree planned.
Doesn't sound like it. They evaluate opportunities based on, does it strengthen their entertainment offering? Does it add capabilities? Does it accelerate their strategy? And they weigh that carefully against the potential distraction costs.
Right.
They explicitly stated they have no interest in owning legacy media networks, and they plan to remain choosy, focusing on growing organically, investing responsibly, and returning any excess cash to shareholders. It's a very disciplined, internal, growth-focused philosophy. So if we try and connect all these different threads, tie it back to the bigger picture for investors, this earnings call really highlights Netflix's, I think, robust position and pretty clear strategic direction. They seem to be navigating this dynamic macro environment effectively, showing consumer resilience, stable engagement metrics. That's crucial in such a competitive space.
So what does this all mean for you, the listener, if you're trying to understand Netflix's core investment thesis going forward? What's the takeaway?
Well, it fundamentally underscores the growing importance of their advertising business, right? And that's not just about selling ad slots anymore. It's really driven by this proprietary tech stack that promises deeper engagement, better targeting, and ultimately more effective monetization. Then you've got their diversified content strategy, everything from original animation hits like K-pop Demon Hunters to expanding live events, these crucial local partnerships like TF1. It all positions them, they believe, to capture more of that huge chunk of TV viewing that isn't yet on Netflix or YouTube.
Right, that 80%.
Exactly. And management clearly believes their big investments in things like AI for content creation and personalization, along with that slick new UI, they see those as genuine force multipliers, things that will boost the ROI on their massive content spend, improve the whole member and advertiser experience, and ultimately strengthen their profit model as they win more of those, quote, most profitable moments of consumer attention.
All right. Now, this is the part of the deep dive where we let our inner, maybe slightly unhinged hedge fund analyst out for a minute. Remember, this is not financial advice at all. It's just a thought experiment for the adventurous among you.
Okay, imagine pitching this to a skeptical investment committee. The trade idea. Go long Netflix calls. Out of the money, maybe. Betting on the rapid and potentially underestimated impact of their advanced AI-driven ad personalization and these new interactive ad formats they're talking about.
Okay, so a bet on the ad tech really taking off faster than expected.
Exactly. The thesis is that this technology won't just double ad revenue this year, as they guided, but that it could fundamentally disrupt the entire media buying landscape, causing their effective CPMs, their ad revenue per user, to significantly outpace not just current expectations, but maybe even their traditional subscription ARPU growth. It's a bet on a paradigm shift in their ad business.
Okay, that's bold. What's the other side of that trade? The hedge or the pair?
Simultaneously, you'd short a basket of major legacy, broad-reach broadcast networks, particularly in key international markets. Think, big European or Latin American public or private broadcasters.
Shorting traditional TV internationally. Why?
The rationale is that their traditional linear ad inventory will rapidly devalue as Netflix aggressively captures the most engaged and targetable audiences globally, specifically leveraging its expanding local ad-supported content like that TF1 deal and that growing slate of live events, because that's where advertisers really want to be. Engaged audiences, local relevance, live moments. It's basically a bold bet on the accelerated obsolescence of old-school linear advertising against Netflix's shiny new ad tech and its increasingly localized event-driven content strategy.
And that wraps up our deep dive into Netflix's Q2 2025 earnings call.
Yeah, we've definitely seen a company that's feeling confident in its financial outlook, strategically really pushing hard on growing its ad business, diversifying its content well beyond just scripted series now, adding live events, and leveraging cutting-edge tech like AI and that new UI to enhance the user experience and hopefully drive future growth.
The path ahead clearly involves significant investments, continued execution risk. But that underlying business strength they talked about, combined with all these strategic plays, it certainly paints a compelling picture of a company really intent on dominating the global entertainment landscape for years to come.
Absolutely. And as always, please remember, folks, this deep dive is purely for informational purposes. It is definitely not financial advice. Do your own research.
We really hope this gave you some valuable insights to consider, though. What stood out to you from this discussion about Netflix's future? Well, let us know. Until next time.